Hey, good morning, everyone. Hey, you need to flex up a little bit. Good morning. Yes. Thank you, everyone, for joining us for this conference. I'm Edson Bope, and I've been joined with my team here. I'm going to let them introduce themselves.
Yeah, I'm Chikadli Obiora.
I'm Jake Reese.
Okay, cool. So we are here to present the pricing data and risk project that we have been working on over the past few years. Can you go to the next slide? I'm going to pause a little bit on this slide. And as you are seeing this slide, I need you to think about it, right? I have a follow-up question. So right now, as I'm trying to speak and buy time, I'm trying to, getting your mind together so that, I think we will have a constructive discussion and presentation on this. If I may ask you right now, what are you seeing? Okay, thank you everyone for those beautiful answers. So what we've been seeing over there is some form of data flow, trying to depict how data flows in the economy. And as you all know, there are those buzzwords and terms that we are all familiar with, including alternative data, right? I think everyone right now at this point in time, I don't know if you could imagine how much data you might be contributing into the data centers as we are sitting right now, as we are presenting, as we are connected to our gadgets. So, as part of this project, the main problem we are trying to address is to price and measure risk information. So, in this moment, you could see that there has been an increase in the need for real-time insights, right? And people have moved from working with more structured data into unstructured data. There's this AI and big data analytics, and now, other than focusing on the figures that we are seeing in the financial statements, more people are now focusing on alternative data and trying to do some ESG, objectives and trying to move their companies in that way. So we have discovered that we no longer have a fit for purpose, way to measure the price of data. And when it comes to size, it's no longer a very good metric to measure data size and try to put a price onto it. Because right now, as you are sitting right there, as you open your laptop, as you scroll over your phone, you are generating almost like 150 gigabytes of data each and every day, and you won't even imagine it. How is that data being used by a lot of companies? So there's a lot of conversations among us that there's issue of regulation, and a lot of economies, a lot of governments have been starting to come up with regulations among data usage and things like that. And when it comes to alternative data, we also have issues to do with integration. How are we going to incorporate that data into our systems? How are we going to convert that data into something that can be used to add value to our companies? And one of the most key variables that is very important when it comes to pricing data is risk, right? So we then try to look at the level of risk that is associated with certain data groups. So you could see that in different economies there are some acts, and there are some fees that are charged when it comes to data breach. So according to the AI Act, they charge approximately 7% of your global revenue. And according to GDPR, they charge 4%, and MiCA charges 15%. And I know recently, I think it's like 2 years ago, when Facebook was fined like 1.3 billion due to data breach. And where does that money go? We should be able, since we are the providers of that data, that alternative data, we should be able to get something out of that. So the main focus of our project is not on collecting that data, but our main focus is on risk. There are a lot of companies and a lot of research that has been doing amongst regulation and collecting aggregating all the data which is available on the internet, private data, we have a lot of it, but our main focus for this project is on risk. And, okay, next. Yeah, thanks. So, as we are generating that information, how best can we try to have a certain control of that information? So we have been working with our sponsor, which is MetaMe. So MetaMe came up with an IQ protocol, which is they tried to aggregate all that information into some iCubes. Those are like your tokenized information cubes that can be put on a blockchain platform. And then you can have some certain level of ownership of that information, and then you can transact with it to everyone who needs to use that information. So as you can see here, I'm not going to go down through the creation of these iCubes, but one of the things that might come into your mind is what are some of the features of these iCubes? And as you know, it's one of those tokens that can be put on a blockchain platform, and it inherently have all those features of assets that can be found on blockchain. So our main focus is on the information cubes that might have visible and invisible data. So on a blockchain platform, or one of these tokens, what you can see is you can be able to find like the metadata of the iCubes, but you won't be able to find the information which is behind that until you transact. So that, you exchange some form of money so that like we can gain something on that. Next. And some of the things that you might not be able to see within those iCubes is these data records. And when it comes to data records, I'm talking about the information that you are generating. It might come into through the form of those like the records that we are all familiar with, like the names, the address, the date of birth, and account numbers. But we can dwell and try to dig deep into some of the information that we might that can be accommodated by these iCubes as well. Next. And these records, they contain a lot of risk. So when it comes to information related to your personal identification, we have a certain risk which is called like identifiability. We also have these kind of risk which include like sensitivity, confidentiality, commercial, and military like risk. Mm-hmm. And as we dive deep into some of the contents that we might find in these iCubes, we have, some. In as much as an iCube can be big as something that can be used to make big decisions in companies, it can also contain some information which is like pretty granularized, like income, outgoings, savings, credit card balances, and loan when it comes to like a budget control IQ, right? So these are like some kind of examples that we can find on iCubes. And when we think about some of the regulations that governs the data protection, we have the Gremlich Bill Act, and we have the Health Insurance Portability and Accountability Act, General Data Protection Regulations. So we use all these and their findings in trying to come up with a price of risk data. So how actually are we going to be doing this? So this was like a high-profile summary of the project, and with my team here, I'm going to let Chikodili go through this as we progress with the presentation. Thank you.
Yeah, thank you. So we've talked about data, and now we want to bring all these messy data together. We want to make sure what we're giving to the user, what we're giving to the investor, whoever that wants this data, it's properly packed together in order. You find that most of the data you have on Yahoo Finance, on Bloomberg, they all look pretty. Everything is on the right column. But actually, someone did the work to make sure these things were properly put together. So understanding, we started before, let's say we want to provide a data for real estate market. We're able to we might not do very well, we might not be focusing on the intuition, the strategies the investor might want to explore. But we want to provide data to this set of classes involved. So we'll start from making sure, we'll start from getting a little bit sample from the location or wherever we want to get those study, and then we'll test it, the next one. Then after testing, we'll see if this data is going to capture exactly the intent, our initial motive. Probably the motive is to provide data that helps value investing, or data that help in intrinsic value, or data that helps in some quantitative strategy. So after we get this data, we'll make sure we'll look at this data and see if this data is able to capture correctly everything we need to provide information to this user. Next one. So when we do that, and then we'll look back and see if what we did is if it captured it. If it doesn't capture it, then we might have to find out some other missing part. So it's actually a very strong intuitive process where we just make sure that we are constantly innovating to capture a market trend, to capture whatever dynamics that the market is improving. Just like now we're talking about AI. What is AI is going to look like in next 5 years? We're already studying on such data, providing information to people that this is from what have done in the past. We've been able to develop the future and what AI is going to capture. So try to get this data based on the use cases, based on the weight across different, we understand who is using this, what problem is this solving. We can finally put up data to the user. Then the next one. Then if as soon as we capture this and it looks pretty well, then we can then scale, because we can then scale and start putting this data in the large using API and then doing it in a scalable way, because we don't want to start with that because of cost and economy in business. So the next one, I think that's all.
Basically, with the way we are like collecting all these informations into like an information cube and trying to sell those to companies out there, just to like be able, just so they can make proper decisions. The one big issue that we had with our risk system that was in place that the previous team came up with was that the weights they assign. So the way we do our risk analysis is we so we have like a bunch of risk categories, and all those risk categories are based on how like a thing performs. So we have like a bunch of high risk items. There could be a bunch of high risk items in your data, a bunch of like low, and a bunch of like medium risk items. So the way our code does is, let's say you pick the investment cube right here, it will count everything that's in the data. In the cube, it could be first name, last name, could be social security number, could be the amount of investments you have, or like what you're invested in. And depending on all of that, it basically gives you a classified risk score, which when it's unweighted, when you just count how many high, lows, and mediums there are, the total risk comes out to be a medium risk. And when you assign weights to those, it comes out to be a high risk. But the big issue when we started was that the way they assigned weights was kind of by judgment. There was no like code set in place, or there was no proper way of assigning those weights. So as a temporary measure, what we did is we kind of just we put a system in place in Python, which what it does is it counts the number of highs in your cube. And depending on if there's a high number of highs, it assigns, it gives all those metrics a bit of an edge compared to the other ones, and it just increases your risk score. So that's why when we like do a weighted system, you can see like it turns out to be a high risk iCube instead of a medium risk. And it also like gives you just scores of what risk categories affect your iCube the most. So in an investment cube, it's reputation and compliance, because there's a lot of things you need to deal with when you're investing. So that was this is kind of like what the previous team came up with. They had a loss calculation, they had a backward propagation, and this is how they were like trying to assign the final weights. The problem with that was it was all just a bit theoretical. There was no framework in place for that. So this is kind of what me and my team came up with is we create an empirical weighted system for this risk that's in place. So the way we're going to do this is we're going to use multiple sources instead of like the previous just highs, medium, and lows that the previous team came up with. So instead of that, we're going to be using multiple sources to be able to assign weights to these risks. And the way we are going to do that is we're going to assign them into like 5 different portions, being historical incident analysis, expert analysis, machine learning optimization, insurance premium data, and regulatory fine structures. We'll get into that, all of that in a second. But why multiple sources is because previously there was a heavy reliance on, there's always a heavy reliance on weightage, but it was all something that the previous team came up with. So there was no like validation behind it. There was no judgment. It was kind of like what they feel should be assigned a higher score. Apart from that, just getting validation because multiple sources just confirms that you're on the right track. And we also wanted to be able to capture the essence of every marketplace, every person in the marketplace. It could be the market, it could be the regulatory bodies, it could be the people who are buying the data.
So in the expert weighted component, our goal was to replicate human scoring with AI-driven assessments that behave like domain experts, such as lawyers or compliance officers, without actually needing to survey real people in these roles. My current task has been designing and preparing expert simulation agents across ChatGPT, Gemini, and Claude. Ultimately, agents will be reading and interpreting regulation-based definitions from our iCube spreadsheet, evaluating these across 22 risk categories, and then ultimately inputting the agent's responses as variables into our Python risk engine in order to compute a total risk score and ultimately price and classify the data cube. To support this approach, I've been developing a structured prompting framework to guide agents through the survey. The prompt contains background that's needed for the agents to best understand the data set being provided to them, context to narrow their focus, explicit instructions to generate survey answers, and finally, we define the tools available to the agents. Looking into the future, most of my focus is centered around refining and optimizing these AI agents. We'd like to identify the minimum prompt information required without risking producing AI hallucinations in order to keep the prompts both efficient and lightweight. And I also plan to standardize agent output into machine-readable JSON code that can be directly inputted into our Python risk calculation engine. Human oversight can help us determine which agents are performing well in their categories and which ones will require additional tuning. And ideally, we would like to produce 2 data privacy lawyers, 3 information security professionals, 3 risk management consultants, 2 data marketplace operators, and 1 regulatory compliance specialist. Finally, we're trying to incorporate feedback loops into our system by comparing historical expert assessments with the AI agents that are attempting to replicate them. And by doing this, we'll be able to identify when the models are drifting or losing focus of their task. By incorporating this human-in-the-loop feedback system, we're hoping to review survey responses, provide corrections, and slowly optimize our agents.
So another big portion of our risk assessment with the historical incident analysis, and the way we do it is we start by measuring the financial impact that these companies have had in the past, and we see what are the primary risk dimensions that were affected. So when the Meta GDPR thing happened, they were fined by the GDPR. The biggest primary risk concerns were they were not compliant. They had a bunch of legal issues, and a portion of it was also geopolitical because European Union has just much better privacy laws than America does. So that was a portion of it. And as you can see, they were fined like 1.2 billion. So what we do is let's say they were fined 1.2 billion. What portion of it was legal? What portion of it was for compliance? And depending on that, we kind of assign different weights to all these, and we then all average it out to one, and that would be 25% of what would affect, that would be 25% of what adds to our weighted risk system that we're trying to build. Apart from that, we still haven't, I mean, it's an ongoing project. The other things that we need to get to is the regulatory fine structures, insurance premium data, and machine learning optimization. The way this works is, the reason we do it separately is because there's historical incident analysis just to see what has actually happened. Then there's regulatory fine structures where we'll basically parse through a bunch of regulations, do a deep dive into the research, do a deep dive into those, and just research a bit of what the regulatory bodies think, how the risk should be weighted, because sometimes there's higher penalties for compliance compared to data leakage. So it kind of depends on what, it would also capture the essence of what the regulatory bodies think. Then there's the insurance premium data, just like capture the essence of how markets think the risk should be priced for the risk should be assigned for a data. And then machine learning optimization, just kind of like putting all this information into an AI and see what the AI thinks of it and what score it would assign to it, and then like combine all the 5 categories at the end and see how it works out.
Yeah, we want to make sure we're selling this data at a fair price. So, yeah, no one wants to sell below the market. So that is, we've seen what the way Dario said, our brain is essentially like computers. It takes in data, and there's more to think about it. And then we'll have different use cases, but we'll be focusing especially on the REIT, the real estate investment instrument. Next one. Okay. So data can be priced, but the approach we use is basically what is the risk of having or not having this data. So if we are providing a data that is going to provide a lot of resource to you, if we're able to develop a new intuitive strategy in the market, just like what we're working on, which combines what Benjamin Graham has, margin of safety, true value, and we had to add a third factor to it, which is intrinsic value. Basically captures upside potential, and it just allows you to explore more upside potential. So if we're able to have this data put in together and we understand the value of this data, we should be able to assign a fair price to it. So that is what we are going to work on. And we also understand the lack of not having this data, what is going to, these are some of the cases where compliance issues and some necessary issues why people need to have this data to properly make better decisions, optimize efficiency in the market. So, no, previous. So, data is actually, the method we are using to price this data, it looks a bit more like option pricing. Maybe not really like black shows, but we're trying to give you a right to upside potential in the market with this data. But the difference is in the execution. We don't offer the right to execute. So we're going to take that into account, and we'll remove that factor in our pricing. And we'll have some of these different places where this data can be sold. And in pricing, we'll use a risk approach, which when we price our data, we're going to backtest them based on the previous prices we've gotten from this market. We're probably focusing on NASDAQ Data Link and Bloomberg. So here we talked about the pricing model, which the first one we're using, we assume prices of this data and is normally distributed, and we're going to use this assumption. with our risk score. We'll price it and then we'll test it again with through the confidence intervals. We're able to test this data with what we have in the market. If the approach we are using properly captures what is available in the market, then boom, we're going to stick to it. Otherwise, we'll explore probably model 2 or model 3, which uses a different approach from normal distribution. And there are also possibility to use Monte Carlo in pricing this data just to get a fair value. And from the previous work, they were able to determine some prices from using the normal distribution. And yeah, this is what they have. And we'll be studying extensively on having a fair price and using statistical model to price the price of this data. And this brings me to the end of our presentation.